goal. But let's shift gears from one corporate voice to another. IDFC first. We delve into the earnings fine print. My colleague Ajay in conversation with V. Vaidyanathan, the MD and CEO at IDFC First Bank.
All right, so we are in the thick of earnings season, and IDFC First Bank is the bank in focus in terms of the earnings. We have Mr. Vaidyanathan, who's the MD and CEO of IDFC First Bank, to talk more about the results. Mr. Vaidyanathan, morning. Thank you so much for your time. Hope you are recovering well from your ligament injury. But clearly, the marathon which you have started here at the bank continues as a very regular and steady clip as far as your numbers are concerned. But we'll talk about the numbers reported this time and the issues at hand in the near term a bit before we go about the exciting part. You shared the 5-year growth plan and guidance as well. I want to talk about the OPEX part first. It has shown a bump up. What are the reason for it? And do you think it will have an upward bias in the short to near term, or is just a one-off this quarter?
So this quarter, our OPEX is a little higher than what we're allowed to see. Actually, the festive period is going on, so there's a little more action, marketing activity, disbursal, etc., and dealer DSA payout, etc. So that was a little more than what we expected, and then a little more technology expenses. I think about 70-odd crore, a little more than what we have loved to see.
Mr. Vaidyanathan, we also see there was a bit of an impact from the RBI new norms as well. I want to talk about this, not only this impact, but also AIF exposure, which you have, and RBI seem to be a bit uncomfortable about the unsecured part of the consumer loans. What are your thoughts on these issues?
First of all, we have no exposure to AIF, so to put it on the side. And as far as the RBI's, you could see that it is there. There is a soft guidance that we should be careful. There's a public commentary coming that we should be careful. And our comment is that, yeah, we should be very, very careful. And we have actually, after the risk weights have gone up, we have slightly increased the interest rates on our personal loan portfolio, and we also tightened some credit norms. We want to slow it down a little bit.
Mm-hmm.
But otherwise, it is quite risk adjusted, and it's quite profitable.
Okay, so even after taking moderate slowdown on the growth and disbursement front, you don't expect a major structural impact on the trajectory and the contribution it makes to your overall book?
No, like I said, we intend to slow it down a little bit because of so much of signals coming. But otherwise, on our portfolio, performance is really very good. And in fact, I think if you saw the gross NPA numbers of our retail portfolio now, which is the retail portfolio, the rural portfolio, SME portfolio, that is 1.45% now. It was 1.52 last quarter. And our net NPA is now 0.51, which is the same as last quarter. So numbers are very strong and stable. There's no issue there as such.
See, your GNPA as well as net NPA, both of them have actually improved 70 and almost 68 basis point QOQ. I want to understand what's the guidance or the outlook on asset quality. You expect it to be steady?
We definitely expect it to be steady. We basically measure it by the input indicators that coming into the NPA. The input indicators are what is our SMA, and before SMA, what is the collection percentage. We publicly report every quarter for all the 3 months of the year. We report a collection percentage. It's coming at 99.5% for the primary bucket. That's really very strong, and there is no weakness there. And on that basis, we've guided for our future guidance as well. But of course, as the markets, we should be always careful for the future. So we've guided for us, we've factored for a slightly higher credit cost. But otherwise, things are quite normal.
Mr. Vaidyanathan, let's move on to the bright spots in the numbers. This time round, again, we see very strong improvement as far as your CASA is concerned. And this is coming at a time when overall environment is becoming a bit challenging. There's a war for deposits, if I may call it, on ground. How are you managing it, and what's your thoughts on it? It will remain for some time now, the pressure there?
Our credit to deposit ratio for the 9 months of this year is only 79.8%, or let's call it 80%, which is quite healthy. For the last quarter, it is more like 65%. So our deposits are coming very strong. Obviously, it's coming more than our loans. So we are holding up quite well there. Our deposits, our CASA ratio is also quite healthy. Um, you know, it's coming along well, and we are not seeing any concern on that front.
Okay. If I could just go back a bit before I come to your guidance, Mr. Vaidyanathan, out of your loan book, the different ingredients of the loan book, what kind of growth versus outlook can you share? Which end of your loan book is growing highest, and where do you see improvement or moderation going forward?
See, except our infrastructure loans, which we are bringing down, already brought down from 22,000 crores to now 2,500 crores, which will hopefully wind itself away. Rest of the portfolio is all behaving well, and we are growing. So we like the home loan business, we like loan against property, we like the car loans, we like two-wheelers, we like the SME loans, we like the rural business. So it's like asking me to pick which of your fingers you like, but they're all good. And our own sense is that the next 4 or 5 years, we feel that picture is quite clear, the coast is clear, the business model established. So we are really looking forward for the next few years, and we want to improve our profitability now. That is our main, let me say, agenda left, because we come to ROA of from 0 to 1. We still, a good benchmark will probably be 2. So that's the only work to be done yet.
Yes, I remember we were talking 2 quarters back, Mr. Vaidyanathan, and you did indicate that Ajay, picture abhi baki hai, and the picture played out pretty well after that. But the issue with this kind of a strong performance, that it also elevates expectations in the market. Now that, okay, let's take a stock of how the first term of your guidance has been so far. How do you rate your own progress made? I have the presentation right in front of me, but where would you see part of your guidance is still work in progress, and which part are you happy about that you have achieved?
First of all, you're forgetting. I didn't say picture abhi baki hai. I said picture abhi shuru hui hai.
Shuru hui hai.
Yeah. So basically, what we have got right thus far is that our deposit strategy has played perfectly well. We are getting good quality deposits. The second part which we got right is the culture in the bank. Plain, straightforward, high quality banking, asking our employees to be truly very, very, very customer friendly and bend backward for the customer. We got culture right. We got deposit right. We also got the loan book right. It's been 5 years. We haven't set 1 foot wrong on lending side, asset quality side. So these things we got right. What we are behind, let me say, a good benchmark are 2 things. Our cost to income ratio is, let me say, has not yet caught up with our peers. It is coming down, but is still far away from where the peers are. And in terms of return on assets, a good benchmark would be 2. We are at 1.1.
Just to let our viewers know, in the 5 years, the first 5 years of the guidance you had given, your customer deposits have gone up 4.5 times. Almost growth in branches. Everybody is talking about branches within your peers as well. Almost 4.5 times. Almost 2 times, 2x is the growth in loan assets. 5x improvement in CASA. Almost 3 times improvement in your pre-provisioning profits as well. Next 5 years, FY29, you gave a bit of a hint that the sole agenda of the bank would be to improve profitability. Mr. Vaidyanathan, talk to us about the levers you're aiming at pressing and what is the scope of improvement in profitability, hence?
See, the levers are easy to understand, actually. For the first 5 years, we set up the infrastructure, the capability to originate this kind of deposits. For a bank, deposits is the most important thing, because it's low cost, it's the source of funds. Now that machinery is set. Now we believe that it is good enough for originating about 50,000 crores a year, and therefore, when we look ahead 4 or 5 years from now, there are few things that will come in our favor. We will pay off definitely all the high cost liabilities that would improve our profits. Some businesses like credit cards will become profitable. That should add to our profit meaningfully. 50 years from now, it will be like solidly in profits. Then the then the operating expenditure of the bank itself should slow down because we got the critical mass. So these are the maybe three reasons why our ROE should start improving from here. And we have guided for a picture of what the 5 years should look like in our guidance 2.0.
That's correct. As far as the guidance is concerned, the ROE which you have indicated could be around 17 to 18%, 1.9 to 2% is the ROA target. And just for the benefit of our viewers, it translates to roughly estimated 12 to 13,000 crore as far as the net profit goes, if the ROAs actually move in that direction. Before I let you go, Mr. Vaidyanathan, a quick word on the environment also. We spoke about near term here and now of your numbers. We spoke about what you're directionally looking at from here on. But I'd like your opinion on the lending environment as well. In the last 2 months, there have been multiple instances where our regulator has spoken about certain sections of the entire credit growth and loan growth in the industry is getting heated. What are your thoughts on that? Companies such as your bank, such as the other, which do very technology-backed SME lending, how are they cushioned now in this environment versus how SME lending used to happen years back?
So, first of all, this is a very important caution, and we are also heeding it. That is one of the reasons, we are also tightening our credit norms. If you notice, our current growth rate of loans is running at 24.5, but for the next 5 years, we are guiding only 20%. Now, we feel 20% should be reasonably very easy to achieve for the bank. That's what we are putting. So that's how we look at the context. Overall, Indian economy is looking good. People income is rising. Growth rate is growing at 7% plus. Real incomes are increasing. So in that sense, it's good. But better to be careful than sorry.
Okay, so that was about IDFC First Bank, but persist.